Okay, we're going to move into chapter 7. And chapter 7, I'm going to break this down into two different videos because these are definitely different subjects. The one of them is going to be reporting and analyzing inventory, and the other one is reporting and analyzing receivables. We talked about inventory in the last chapter, so we'll skip some of this. But again, you should be able to look at the balance sheet of a company and determine what type of company they are. If they're a service company, they're not going to have any inventory account at all. If they're a merchandiser, they're going to have one inventory account, as you can see here, and that's merchandise inventory. If they are a manufacturing company, they're going to have three different types of inventory. A manufacturer takes raw materials, they assemble them into something which is called finished goods. So you have the raw materials. A car manufacturer would have lots of different raw materials. They would have batteries, engine blocks, and then even if you make the engine blocks, of course, you can have raw materials for that, aluminum or however those whatever engines are made of. But you would have wiring, you would have fuses, you would have lights, you would have steering wheels, different parts of the engine or the transmission, the radiator, spark plugs, etc. And so those are all raw materials. And so those would be at the end of the month, you would inventory what those are. So those are just sitting there waiting to be worked on. Work in process, of course, would be we're in the middle of working on something. And in a later chapter, we'll go through that more precisely to see how we actually determine work in process. And so, work in process would be at the end of the month, we have are in various stages with different um, items. So, you could have a car that's 99% complete, but it's not complete. So, you would hopefully be able to say, well, I'm going to account for 99% of the cost. If you have ones that are 50% complete, then you would add 50% of the cost, etc. And so once they are complete, then they become finished goods or ready to sell. And you can see here that regardless of the classification, companies report all inventories under current assets on the balance sheet. It's in the last chapter that under the periodic and perpetual system, you will do inventory, but the perpetual system will really only be like an inventory maybe once a quarter, maybe once a year. Whereas the periodic system, you have to determine the inventory on hand every month. And then you determine the cost of goods sold based on what you started with, what you bought, and what's left over. That difference is going to be cost of goods sold. System, of course, that is tracked. Um, and every time you add to inventory or subtract from inventory, those records are kept. So theoretically, you know how much inventory you have every single moment. So companies often take inventory when the business is closed or when business is slow. My wife is a CPA and she works for a public accounting company. Although she doesn't work in audit, she lives in Nashville, and because of that, she was asked to go take an inventory sample at a factory in Lebanon. So I drove her out there and she went in and she verified their inventory by looking at different samples. Goods in transit, again, you need to determine you have FOB shipping point. Remember that is the point at which the buyer takes possession. It also determines who pays the shipping cost. So FOB, free on board shipping, means the buyer takes possession once they are in the truck and leave. and so they pay the freight cost. FOB destination means that you don't take legal title until the goods are at your factory or at your warehouse. Okay. And you can see here, this is a representation of that. I also discussed that Amazon, if you're a Prime member, you're probably looking at FOB destination because the seller pays the freight cost. One other note to remember is bringing inventory into your warehouse that you will sell would be the cost of the inventory and the shipping if you pay that. But if you send items to a customer, those are expenses. And then there are consigned goods. In some lines of business, it's common to hold the goods other parties and try to sell them for a fee, but you don't take ownership of the goods. So those really are consigned goods are the property of whoever owns them. So a used car dealer might be willing to put the car on its lot and charge you a commission if it's sold, but it's not their inventory. The Has Been Company completed its inventory count. It arrived at a total value of $200,000. You have been given the information listed below. Discuss how this information affects the reported cost of inventory. Has been included in the inventory goods held on consignment for Falls Company cost $15,000. Well, they don't own those goods, so you would need to subtract that. So you're looking at inventory now actually 185,000. The company did not include in the count purchased goods of $10,000, which were in transit, terms FOB shipping point. Again, that means that at the shipping point is when the buyer takes takes legal title to the goods. So they should have included that. And so that brings us back up to 195,000. The company did not include in the count sold inventory with a cost of $12,000, which was in transit. Well, that's correct. If they sold it, then they no longer have inventory. That should have been a cost of goods sold. So I would say that the inventory should be $195,000, and the program agrees with me. So it's not just simple of bringing inventory in and then pricing it out. There are different inventory flows, and we're going to talk about those. Mainly, we're talking about FIFO, first in, first out, LIFO, last in, first out, and average. And depending upon your inventory method and depending upon the economy and whether there's high or low inflation, the determination of how you value inventory will have an impact on your financials. Inventory is accounted by cost. Again, all of the different costs that go into the inventory adds to it. Any discounts you subtract from it, any returns you subtract from it. Again, freight in is part of the inventory. Unit costs are applied to quantities to determine the total cost of inventory. And cost of goods sold usually fall in costing methods, specific identification. Cars, I mean, you have a car and you buy it from the manufacturer, you know how much it's going to cost. And so you sell that specific car. And so when you do, you deduct that from inventory and you move it over to cost of goods sold. But absent specific identification, which really only applies probably to large items that you can track specifically by a serial number, you have again first in, first out, last in, first out average cost. So we're going to talk about this. So we purchased a TV at $700 on February 3rd. On March 5th, we purchased a TV at $750. On May 2nd, we purchased a TV for $800. In June, we sold two of the TVs and we sold them for $2,400. So that's $2,400 revenue. What is our cost of goods sold? Well, that will depend upon the method that you're using. Now, this might be one that you could specifically identify. And so if you did that, you could go, well, let's see, I actually sold the February 3rd TV and the May 22nd TV. So my cost of goods sold is going to be the cost of them, which is $1,500. And so the ending inventory is 750. So that's specific identification method. But normally stores sell a lot of TVs. So I don't know that they were going to track those. They might. So again, let's look at the other methods: first in, first out, last in, first out, average cost. So we're going to be starting to refer to these as FIFO, LIFO. All right, so we've got another cost flow assumption where we have beginning inventory of 100 units, unit cost of $10, total cost $1,000, and we will continue that. And so the total units available to sell would be 1,000. And the total cost of all of those units is 12,000. And so if we use the average cost, you can see here that that's going to be $12 average cost. But the units in ending inventory were 450, so we sold 550 units. So again, beginning inventory plus purchases minus ending inventory is equal to cost of goods sold. So we have to determine these amounts. FIFO, first in, first out, assumes that the earliest goods purchased are the first ones to be sold. Now, it may not translate into the actual specific item, so we don't go and say, well, let's, move these in by date, and so we're only going to sell these. But from an accounting standpoint, that's how it's done. Cost of the earliest goods purchased are the first to be recognized in determining cost of goods sold. This does often parallel actual physical flow, depending upon how your warehouse is set up. But the oldest units are not necessarily sold first, but that the cost of the oldest units are recognized first. If these products have some type of impact as far as um, technology, then that might be a different issue. All right, so cost of goods sold available for sale. Again, total costs are 12,000. And so we sold 550 units, so we have 450. So we're going to actually start backwards. So the first 400 are going to be the last 400 that we sold. Okay, again, first in, first out. So what we're trying to figure out is what do we have left? Well, um, in this case, we're going to look at the last ones we bought. So we're going to start with 400 units times $13 is equal to 5,200. And so then we're going to go to the next tranche. And so we're going to take 50 of these units purchased on August 24th, multiply that by 12, and that gives us $600. So our total inventory is going to be $5,800. So again, we started beginning inventory plus purchases less ending inventory is equal to cost of goods sold. So you see there, cost of goods available for sale were 12,000, ending inventory 5,800. So our cost of goods sold is 6,200. All right, so 5,800 and 6,200. And here's sort of a representation of cost of goods sold. So the first units that we have are out the door. The last units that we have are still in inventory. So here's the FIFO method. The accounting records Shumway AG implements show the following data beginning 4,000 at 3, 6,000 at 4, 7,000 at 12. Determine the cost of goods sold during a period under the periodic system using the FIFO. So cost of goods available to sell would be the total of the units times the price, okay, and that ends up to be $36,000. Ending inventory, we have 3,000 units, okay, or I'm sorry, I'm reading this incorrectly. So beginning inventory is 3 times 4 is 12,000. Purchases, 6 times 4 is 24,000. So that's 36,000. And then we have sales at $12 to 7,000 units. So we're going to end up with 3,000 units basically. And so we're going to take the ending inventory of 3,000 times 4. So the cost of goods sold is 36 minus the inventory that we have still on hand, and cost of goods sold is going to be $24,000. So again, cost of the latest goods purchased are the first to be recognized in determining cost of goods sold. All right, so now let's look at last in, first out. And so beginning inventory, same thing, but now we're looking at the last in. So when we sell units, we're going to sell them from the bottom. And so our ending inventory of 450 units is going to be comprised of 100 beginning inventory plus 200 of this purchase, that's 300, and then half or 150 of this unit. And so we got 100 times 10, 200 times 11, 150, half of these times 12. And so our ending inventory is 5,000. So the cost of goods sold is cost of goods available for sale, 12,000, minus ending inventory of 5,000. So our cost of goods sold is 7,000. And so let's just go back. So here, our total cost was 5,800, or total inventory is 5,800, cost of goods sold 6,200. Here's 5,000, 7,000. So you see that under the LIFO, our remaining inventory is going to be lower than under FIFO. And that's because we're keeping the oldest units, the oldest cost units. But our cost of goods sold is going to be higher. So our net income is going to be lower. So under FIFO, our net income is going to be higher and our inventory is going to be higher. Under LIFO, our inventory is going to end up being lower. Our cost of goods sold are going to be higher, which means our net income is going to be lower. And so here's the opposite. We're keeping the first units, we're selling the most recent purchases. So similar type. And so here again, instead of 24,000 cost of goods sold, we have 27,000 cost of goods sold. And then we have average cost, and that really is just we take the total units, we take the total cost, divide by that number, and that is what will give us our results. So this is sort of in the middle, which is what you would expect. $5,400, $6,600, and hopefully they have, okay, so weighted average again is just 450 units times the average cost, and the units sold is number of units times the average cost. It's similar again. So you see this is 25,200. So we went from 24,000, 25,200 to 27,000. And so you can see that these truly give you a different result as far as what is in inventory and what your cost of goods sold are. The reasons companies adopt different inventory are varied, but they usually involve either income statement effects, balance sheet effects, and tax effects. And you can do things differently per GAAP compared to how you do them for your income statement or your taxes, income taxes. And normally for income taxes, you want to have the lowest income possible so that you pay the lowest taxes. Eventually, it's all going to work out, but money today is worth more than money a year from now. So even though on average you're going to have the same amount of net income, if you have lower net income now, you're going to end up with more cash now. So, the time value of money becomes important. So in periods of changing prices, the cost flow assumption can have significant impacts. In a period of inflation, FIFO produces a higher net income because lower unit costs of the first units purchased are matched against revenue. So, you could have units that were $12 and now they're $18 because of inflation. And under FIFO, you're going to sell the $12 units, which is going to mean that your inventory is higher and your net income is higher because your cost of goods sold are lower because you're selling off the cheapest. Um, LIFO is the exact opposite. So LIFO produces a lower net income because higher unit costs of the last goods purchased are matched against revenue. And you need to spend a little time to make sure that you understand this concept. If prices are falling, the opposite is true. Results from the use of FIFO and LIFO are reversed. If prices are falling, then FIFO will report the lowest net income because now, and this is really unusual, doesn't happen very often, but now you're selling off the more expensive units because the newest units you bought were cheaper. And again, LIFO is the opposite. So this is something that you should be familiar with. If costs are rising, net income under FIFO is higher and under LIFO is lower. And if costs are falling, it's the opposite. A major advantage of FIFO is that in a period of inflation, the cost allocated to ending inventory will approximate the inventory's current cost. So because you're selling units you bought previously, what you keep in inventory is what you bought most recently, and that does reflect the actual cost that you will incur if you continue to buy more inventory. So under FIFO, you're really underestimating your inventory. Under FIFO, it's more representative of what your actual inventory on your books is. Under LIFO, it's the opposite because you keep the cheapest things, but when you buy new inventory, you're going to have to pay more. And so many companies have selected LIFO. Why? Because it results in lower income taxes. Again, you're selling the most higher priced units. And so that means that your net income is lower. And so that means your taxes are lower and you keep more cash flow. The cost flow method that often parallels the actual physical flow of merchandise is I'm going to go with the FIFO. All right. In a period of inflation, the cost flow method that results in the lowest income taxes is all right, so a period of inflation, that means that what you bought recently is the higher priced. And so you will want to use the LIFO method because your cost of goods sold would be higher, your net income would be lower, your taxes would be lower. All right. The next presentation will be starting with